Good evening, everyone. My name is Olamide, and I'll be moderating today's session. I hope everyone is doing good. It's been pretty warm outside today, so I hope you had a good chance to go out, get some fresh air. So before we get started, we would be doing the land acknowledgement, and Wendy will be taking that. So I'll just pass it off to Wendy for now.
Okay, hello, thank you, Olamide. I'm Wendy Beckles, and I'm one of the directors of the Canadian Multicultural Lead Organization, and it's my pleasure to do our land acknowledgement this evening. So as treaties people on Turtle Island, we are obligated to uphold treaties made from a long time ago. Where I am situated, I would like to acknowledge the traditional territories of the Mississaugas of Scugog Island First Nation, the Mississauga peoples, and the treaty territory of the Chippewas of Georgina Island First Nation. I also want to thank the First Peoples on their ongoing teaching of how we are to learn on the land and from the land in partnership with each other, the animals, and the plants.
Thank you, Wendy. Welcome everyone to part 2 of our taxes series. Thank you to everyone that joined the last session. If you didn't get the recording to your email, please shoot me a message and I can send it over to you. Today we'll be going over taxes again, and our speaker today is Astrid Smith-Breedy, CPA, CGA. Astrid brings more than 30 years of financial experience to our Let's Talk Taxes series. Astrid is also one of our program directors here at L.E.A.D. So she'll be building up on information that was shared last week. So please try to stay attentive and take notes and ask questions. Over to you, Astrid. Welcome.
Thank you very much. Thank you everyone for coming for part 2 of our tax session. I am going to take off my video because just preserve bandwidth, because where I am, the internet is not very stable. But I'd like to welcome you all to this session, the second part of this session. And a quick agenda. This is what we're going to be doing today. We're going to do a quick recap of what we talked about in last week's session in part 1. And then we're concentrating this particular session on the actual filing of the return. So we're going to look at the steps in filing a return. You know, how do you get started, how to file your return. I'm going to go through the T1, which is the income tax return that an individual files. And I'm just going to be zooming in on more of those common income and expenses that you would have. I'm also going to talk about filing your tax return online and what you should include with your return, whether you file it online or whether you file a paper return. And then after you file your tax return, what do you need to know and how long should you keep your records? So quick recap of last week's session. As I mentioned, Canada's tax system is based on a self-assessment principle, which means that you file or complete a tax return each year and report your income and calculate whether you owe taxes or you're entitled to a refund. In Canada, you're taxed based on your residency, and you have to pay taxes on your worldwide income. So that's not only the income that you earn in Canada, but any income that you earn outside of Canada. You should complete a tax return each year, whether you owe taxes or get a refund, because there's some credits that you may be entitled to, such as the GST credit or the Ontario Trillium benefit that you can get, but you'll only get those if you file a tax return. The deadline for filing is quickly approaching. So for filing and for payment if you owe taxes, it's April 30th. And so that's coming up pretty quickly. And you should file your tax return, even if you don't have the money to pay and you owe, file it by the due date so you can avoid penalties. And if you file it by the due date, you'll avoid the 5% penalty. We also know that if you don't pay and you owe, by May 1st is when the interest date will kick in. And because of the COVID year, there is a relief that you can get if your income is less than $75,000. you've received either the CERB or the CSB, the COVID benefits, or unemployment, you file your return and you owe taxes. And if you qualify to get that relief, the interest will not kick in until April 30th of 2022. CRA has a lot of online services where you can get some of your tax information. There's a voluntary disclosure program where if you made an emission on your tax return and you want to come forward and report the unreported income that you didn't include on a previous tax return, you can get a benefit of not having to pay penalties, and you may be able to get some interest relief on that. There's also the taxpayer relief program where you can request the penalty and interest relief if in certain situations, if there are extraordinary circumstances beyond your control, like if you illness, sickness, earthquake, fire, flood, or if there was an error on the part of the CRA, either in providing information to you or if there were delays. If you're not happy with the CRA and the service that they provide to you, you can always file a service complaint. And if you're assessed taxes and you don't agree with the taxes, an option that is available to you is to file an objection. So those are the things that we covered in our first session. So let's move on to part 2. So I'm going to go through the steps that you need to file a return. It's very important that you understand not only what's taxable, what's not taxable, but you should also be prepared when you're filing your return. It's a lot less stressful when you have all your information together and you have to file your taxes, whether you're filing it for yourself, whether you're paying someone to file it for you, or a friend is filing it. It's always, if you're organized, believe me, the stress is it's a lot less. So the first thing you should do when it comes to filing your tax return is to check and see what's new in for the current year's taxes, because every year things tend to change. So there may be a benefit there that you didn't know you're entitled to, and it's there. So you need to know, well, what's new this year? So for 2020, things that are new are the other employment expenses, which is if you work from home in 2020 due to COVID-19, you may be able to claim certain employment expenses. And I will go through and I'll talk about that, what that is and how that amount is calculated. Okay. Also, the basic personal amount, your spouse or common law partner amount, and your amount for eligible dependents have all increased this year. There's also something new called the digital news subscription expenses for 2020. And this will be from 2020 to 2024, where you may claim a non-refundable tax credit for expenses you paid for a digital news subscription with a qualified Canadian journalism organization. There was also a Canadian tax training credit that was introduced this year. And if you are claiming the Canadian Canada training credit, it will affect what you can claim for tuition. So be aware of that. Another thing that has changed is the donations and gifts. There's now a simplified calculation in calculating the benefit you get when you donate to a registered charity. So those are some of the things that are new this year. Get all your documents ready. Very, very important. Gather your tax slips, your receipts, any supporting documents, including self-employment income. If you have foreign investments or any kind of earnings, always get your documents together, okay? Understand your tax slips, like your T4, your T4A, and when you'll receive them. Most of your tax slips you get by the end of February. And if you don't get your tax slips by the end of February, contact the organization who are issuing those slips to follow up on why you haven't got them as yet. Normally your T4, which is what you get for your earnings from your employer, you'll get that by the end of February. So let me go through some of the most common slips that most of us will have. I'll just go through and tell you a little bit about what they are. The first one is your T4, which is your statement of remuneration paid. Basically, you get that from your employer. It tells you how much money you've earned for the year. It will show you your total income. It'll show you taxes that have been deducted at source by your employer. If you contribute to your Canadian pension plan, your CPP, it'll show you what the deduction was for the year. It would also show you what you have put into your employment insurance premiums. All of that will be summarized on your T4 slip that you get. If, for example, you don't get your T4 slip by the end of February, you can still file, because in many cases, every time you get paid, you have a record of your employment, and it's always cumulative. So in 99.9% of the cases, your last pay slip, say for 2020, will contain the same information that will be on your T4 slip. Another statement that you will get is a T4A, which is a statement of pension, retirement, annuity, and other income. And this slip shows any scholarships, fellowship, bursary income, payments made to you from your registered education savings plan. If contributions were made to your RESP, which is your registered education savings plan, and you have withdrawn that money because you're in university, that you'll get a T4 slip for that. If you received the Canada Emergency Response Benefit, CERB, or the Canada Emergency Student Benefit, CESB, you will also get a T4 slip. Another one that you might have had this year is the T4E, which is a statement of employment insurance or other benefits. If you were unemployed or you got laid off from your job and you didn't get CERB, you may be getting a T4E for your unemployment benefits that you received. If perchance you withdrew money from your RRSP, your registered retirement savings plan, you may get a T4 RSP, which shows how much money you withdrew or received out of your RRSP and how much tax was deducted from that. If you had any investment income, you would receive a T5 from your investment institution or your bank, or if you earned interest on a bank account, you would get a T5, which is a statement of investment income slip from the institution. If you are dealing in securities, buying and selling stocks, you may also get what's called a T5008, which is a statement of securities transactions. And remember, if any of these investment incomes or any income that you receive is in US currency, for example, or is in a foreign currency, you need to translate that into Canadian dollars. And where you can get the exchange rate is on the Bank of Canada website. They'll have the exchange rates, and they have the exchange rates there monthly, annually for many, many years. So you can get that information from there. Those of you who are students, you'd also get your T2202, which is your tuition enrollment certificate. And this is an official income tax receipt issued by your qualifying educational institution for the tuition that you paid during the year. So if you go to a college, a university, or any other educational institution that qualifies, you will get your T2202. And this is what you will need the information on this slip in claiming your tuition credit, which will help you reduce your tax that you have to pay. Also get your information on any credits or deductions that you might have. For example, if you had any medical expenses, get all those medical slips together and have those available. If again, the new credit this year, the digital new subscription expenses, if you paid that to the Toronto Star, to the Globe and Mail, and you have your receipts, get all your receipts together. If you make any charitable donations, and you have for the various organizations, many people tend to make donations to different organizations, get all of that information together. If you pay professional dues, I'm a member of the CPA, so annually I pay dues. You'll get whatever you pay, you can get that as a credit. No, you can claim that as a deduction, but you can only claim that as a deduction if you pay that out of pocket. So if you're working for an organization that is reimbursing you, like the organization that I work for, I get my professional dues reimbursed to me. So I cannot claim them as a deduction because it's not coming out of my pocket. It's being reimbursed. If you have a student loan, interest on a student loan, you can get a credit for that as well. If you have children and that fit the category for childcare expenses, you may be able to get a deduction for that. So what's important is gather all your receipts. Another common receipt is your RRSP, which is your contributions that you made to your registered retirement savings plan. What the contribution that you can make is based on the employment income that you earn. What's important is that you get all of these receipts, have them together. For me, what I do, and a little tip that I use is, I know I have to pay taxes every year. I know I have to file a return every year. So as I always are cognizant of, well, what is this? Any receipt I get, is this a tax receipt that I'm going to need for my taxes come the end of the year? Sometimes nowadays, more and more, we're getting stuff electronically. So what I do is I set up an Excel spreadsheet and I record my expenses as I incur them. So I don't have to come to the end of the year and have to reconstruct. When I do my charitable donations online, a lot of the times they send you to your email. I have a folders that's set up by year for each of my taxes. So I have 2020, anything that that comes in electronically that I can probably claim in my tax return, I put it into that file. So it's all in the same place. So I have my electronic Excel spreadsheet that I'm always adding stuff to and keeping a running total of everything. So I come the end of the year, I don't have to scramble, and look for all the receipts that I might need. I also have like a folder, like a folder 2020 taxes on it, that any paper receipts that I receive, I put in that folder. So come the end of the year, it's all there. I don't have to go. I have a property that I rent. So what I do is any expenses that are incurred, again, there's a separate spreadsheet for those expenses and the income that I earn. So come the end of the year, it's all there. It makes it so simple because all the information is already there. I don't have to go scrambling and reinvent the wheel. Another thing you should be aware of are the dates. Okay, do you know that April 30th is a deadline that most of us have to meet? If we have self-employment income, it's June 15th, and that also applies to our spouse if we have self-employment income. An important date is the RRSP date. It is past now. This year it was March 1st, but be aware of that because if you contribute to your RRSP, you can get a deduction on your taxes. And if you are an employee and you have employment income is your only source of income, there are not really many deductions that you can get. One of them is the RSP one that you can get. And if you do your dry run, I always do a dry run. And if I realize, maybe I have to pay taxes and I don't want to pay taxes, if I have contribution room, what I will do is I'll make a contribution to my RRSP. And I normally do my dry run before the deadline for RRSP. So I know if I have to make an additional contribution to my RRSP to either reduce my taxes or put myself in a refund position. Now, there's several ways that you can do your taxes, and I'll go through each one of them in detail, but they're a little bit later. But find out the different ways that you can do your taxes. There's several ways to do your taxes. And further on in my presentation, I will go through the different methods of filing your taxes. Keep your CRA information up to date. We talked about that. I talked about that last week. All your personal information. Keep that information up to date. Let the CRA know of any changes. If you changed your address and you're still receiving a check, potentially receiving a check, you want to make sure it goes to the right place. If your marital status has changed, you want to keep that updated because a lot of the times in calculating benefits that you may be entitled to or any kind of credits, they look at both yourself and your spouse. So you want to keep that up to date. If you've changed bank accounts for whatever reason, you want to make sure that your direct deposit information is always kept up to date. So when you've done all this information you have, you report your income, you claim any deductions, credits, or expenses that you might have. You'll find out if you're in a refund position, which means that more money was taken out of your return of your pay, whatever, or then you or they weren't aware of any credits that you may have or deductions that you may have to reduce the taxes that you have to pay. So that's great news. You're getting a refund at the end of the year, or you may not have, or you may have to pay. Now, if you have a balance owing, you have to pay. And then once you've done your taxes, you send in your tax return. So as I said, gather all your information. Being prepared and organized will make your completing your return a smooth and an easy process. Even if you're not doing it yourself and you're giving it, say you have an accountant that you're giving it to, or your tax preparer is preparing it for you, having that information ready, and you can just say, here is my file with all my information in there. It will also be cheaper for you than if they have to reconstruct your records to get the amounts they need to file their tax return. Like if I was going to somebody, I can give them my rental income and expense spreadsheet that shows everything. It has a total with all the income, with all the expenses. So they just basically have to plug in a number. A lot cheaper than if they had to go through all your records and do the same thing. So save time and money by being organized. Very important. So what are you going to need to get started? You're going to need all your T-slips that I mentioned earlier. And you are responsible for reporting income from all sources to avoid any penalties and interest that may be charged. As again, if you don't have your slips by at the latest early April, do something about it. Contact who you have to contact to get those slips. And even if you don't have a slip and the due date is fastly approaching, if you can estimate the amount of income that you have, do so, right? You cannot do that, estimate the amount of income that you have. If you overestimate it, you can always amend your tax return. After the fact, you can always amend your tax return by filing what's called a T1 adjustment. But what's important is that you file and you file on time. Okay. Sorry. So there are several different ways to file. You can file online, okay? And this is where what is commonly known as net file. But when you file online, this is when you're doing it yourself. It's important that you use a CRA approved software. If you go onto the CRA website, you will see that there are tons and tons and tons of CRA. I was surprised when I was researching, putting this presentation together, and I went onto the CRA website. I was surprised how many different certified softwares there are, and quite a few of them are free. So they are available online. You just go and look. Use a certified CRA software. Again, the cost can be free or it can vary. And what's good with, if you file online, you get your refund really, really quickly. You can get, I filed online for myself and I got it within 2 weeks. I got my refund. So filing online, it's really good. Another good thing about a CRA certified software, and if you've signed up to my account, there's this feature called autofill my return. And this is a secure service, secure CRA service that lets you automatically fill in certain parts of your return. And what's good about it is your employer has to file your T4 slips with the CRA. So if you use your auto fill my return, what it does, it pulls that information that has been filed with the CRA. So you don't have to input the stuff that's on your T4. Some of your other information is automatically populated into the software that you're using. So it's a lot easier. Another good thing that I find with using the software is a lot of them are easy. Trust me if I tell you it's easy. I am technologically challenged and I use the software and it's easy for me. So if it's easy for me, for all you people out there, I can tell you it will be easy for you. So it's very easy to use. And a lot of them have the option of let the software decide, okay? And when it says let the software decide, it is such a way where it'll organize things when it comes to claiming certain deductions. If you have a spouse or you have children, where it maximizes the benefit that you receive in terms, it either reducing your taxes. So it allocates things so it's beneficial to, to your filing situation. So the online is one way of filing. Another way of filing is what's called e-file. And when we talk about e-file, it's like if you go to a tax preparation service, like if you see them in malls come tax time, like at H&R Block, several different places where you could go, or there's a tax or a discounter, which is where those services where if you're in a refund position, they'll say, okay, I'll give you a refund today, but you're going to get it slightly reduced. So maybe if you'll get 85 cents or 95 cents to the dollar when it comes to your refund. So that's a discounting service. Or you can authorize a rep to file, like if you can, your friend or, a family member to authorize to file. That's like, using a separate tax preparation service, and they e-file as well. So you'll get back your refund if you're in a refund position pretty quickly if you use those methods. The paper return is the old tried and true method. Using the paper return, you can get your income tax package, which includes a return and all the forms. It is more difficult because you really have to know you may not be aware of what you're entitled to. You'll read your return and you'll probably claim the basic stuff, but there's stuff that you're not entitled to. Another kind of drawback when it comes to the processing time. For processing a paper return, normally it's about 4 to 6 weeks, but with COVID, it's looking more like 10 to 12 weeks. So if you're in a refund position and you can wait, not a problem. If you want to get it more quicker, you want to consider one of the other methods of filing. You can also file on the phone, which is called File My Return. And this is a free and secure and easy to use CRA service. If you are eligible to file using this method, the CRA would have sent you an invitation letter saying that you can file. And all it is back in the day, I had used this service. You just basically call, you put in some information, it asks you some questions, and that is it. It's normally the people that are invited to file are people with low or fixed income and a very simple tax situation. So those are the ones that would normally get this invitation from the CRA to file on the phone. Last but not least, there's also the Community Volunteer Tax Clinic. And these are free clinics that have volunteers who help complete your taxes for you. To obtain this particular service, you normally have to have low to modest income and a simple tax situation. This service is free, and to get your refund, it's about 2 weeks to get your refund, just like with all the other online services. So what I'm going to do now is I'm going to go through what your T1 tax return looks like. There are basically 7 steps in your T1 tax return. I'm going to talk about what information you have to include in there. I'm going to talk about the income, what income's taxable, what income's not taxable, what kind of deductions you can get, or what kind of credits you can get, how your tax is calculated. So in the identification section of your tax return, it's normally 2 pages. It has the stuff which you would expect: your name, your address, your social insurance number, your date of birth, your language of correspondence, your email address. If you're registering to receive email notifications, you can put that in there, your marital status, the province that you're located in at the end of the year, information on your spouse with their SIN. If you want info from Elections Canada, if they can contact you. Another thing that's on there, it's what's called the information on your foreign property. If you own certain foreign property that's more than $100,000 Canadian, you have to report that. Normally, if it's a vacation property, normally that you don't have to do that. But if you have a foreign property that you're using as a rental, you have to report that. And you also have to file an information return that goes along with that, called a T1135. Failure to do so, you will be subject to penalties. Okay, so all of that is on your first page, your first and second pages of your return. So let's look at what kind of income is taxable, what kind of income is not taxable. Okay, as I mentioned earlier, as a resident of Canada, you are taxed on your worldwide income. Most income that you will receive will be taxable. Employment income is taxable. emergency response benefit and the Canada Emergency Student Benefits, those are taxable. If you are working in a restaurant and you get tips, your tips are taxable. If you are a casual worker, summer worker, seasonal worker, and you are they're not, and they're paying you, you know, maybe not even not taking out deductions, but they're paying you in cash, that is taxable. If you are net research grants are normally taxable. Research grants that you receive are normally taxable. With research grants, however, you can deduct certain expenses in relation to the research grants, and that will reduce the amount that you have to pay in tax. If you receive the universal child care benefit, that is taxable. If you received employment insurance and other benefits, that's taxable. If you received interest and other investment income, that is taxable. If you sold capital property, for example, if you sold stocks and you made a gain, the gain is taxable. If you have a residence that's not your personal residence, you have a house that is an investment property and you decide to sell that, that is capital property, that is taxable. If you sell your personal residence, it is taxable, but you may be entitled to what's called a principal home exemption, and you can get what you owe reduced. Rental income, if you have a rental property, that is taxable, but you can have your rental income and you can deduct expenses in relation to your rental property. If you paid utilities for the tenants, any repairs in relation to that. If it's a sole rental property and it's just one house, you're not living there, you can claim. If you have any interest, if you have a loan that you're paying off that property, any interest on that, you can claim. Any property taxes on that, you can claim. So you have to report your rental income. If your gross and your net, which gross is your total before expenses, net is after expenses. If you have self-employment, you have a little business on the side that you are doing. If you're selling Tupperware, for example, to make extra money, or a lot of these other different, make money individuals use to make money, you're taxable on that as well. You have your total income, and you can reduce it by any expenses in relation to the earning of that income to come up with what your net income is. If you are a student and you received your registered education savings plan, you also have to report that. You would have received a T4A for that. You have to report that. If you are a student and you receive money for a postdoctoral fellowship, that is taxable as well. Now, I know some of you on the call are students, so I'll talk a little bit about for you as a student. They are what do you call, if you are a qualifying student, the qualifying student is defined basically, you're in a program. So if you go to a qualifying college, normally all the colleges and universities fit under that, and you're a full-time student. That's what we, for example, that's for simplicity's purposes, that's what you are considered to be a qualifying student. Okay. If you are in a post-secondary program that consists mainly of research, you're eligible for a scholarship exemption. So even if you have to report a part of it, there is a scholarship exemption that will deduct a portion of what you have to pay, so you will not be taxable on the full amount. But that you're only the scholarship exemption is only available to you if it leads to a college degree or diploma, bachelor, master's, or doctoral degree equivalent. For those of you that are students, a very good resource for students is from the CRA. It's called the P105, and it is called Students and Income Tax. Very, very good document that you should access. You will also be sent after this session. You will be sent a list of resource documents, either that I've pulled a lot of the information when I was preparing this presentation. So that will also be sent to you. If you are if you're in full-time enrollment, and you receive a and you are at a post-secondary institution, the scholarships, fellowships, and bursaries are not taxable if you receive them in 2020 for your enrollment in the program, if you're considered a full-time qualifying student. So that's good to know. If you are a part-time, if you're only in part-time enrollment and you received a scholarship, you are entitled to, you can get it partially as an exemption, what is equal to the tuition or any cost related to program materials. So you can get a deduction for that. If you were apprentice and you received apprenticeship grants, those are taxable, but you may be able to get a deduction if you have to get tools that you use as part of your apprenticeship. So I know it sounds like everything is taxable. Most things are taxable. But good news, certain things are not taxable. So I'm going to go through some of the things that are not taxable. If you get your GST, HST credit, or any of the provincial or territorial credits, like the Trillium credit, those are not taxable. Canada Child Benefit payments or related provincial or territorial program benefit payments are not taxable. Lottery winnings are not taxable. So if you won the lottery, unlike the US where you have to pay the tax man, your lottery winnings are yours, 100%. Most gifts and inheritances, those are not taxable. Amounts received from a life insurance policy following someone's death, those are not taxable. On most cases, when you receive money, if you withdrew money from your tax-free savings account, your TFSA, that's not going to be taxable. Okay, so I've now gone through what are taxable, what are not taxable. So when you're doing your tax return on the third page where you're recording all your income, you list all of your sources that are taxable, you add them all together, and you come up with a total, what is called your total income. So from your total income, you are allowed to deduct certain expenses. So I'm just going to go through the common ones that you would have. Any payments that you make to your RRSP deduction, that is used to reduce your total income in coming up with your net income. If you work for a company or government where they've set up what's called a registered pension plan, and they're taking money out of your salary every paycheck to put into this pension plan. It's set up by your employer and it's registered with the CRA. You can also deduct those payments that you put into that pension plan, very similar to an RSP deduction. If you have to pay annual union dues or fees, and again, if you're not being reimbursed by your employer, you can also claim that as a deduction. If you have eligible childcare expenses, you can claim that as a deduction. Normally, it is the spouse with the lower income that claims the childcare expenses, but in certain circumstances, if your spouse or partner is enrolled in an educational program, you may be able to claim it. The spouse with a higher income may be able to clear it. If you have incurred carrying charges or interest expenses for investment purposes, you can claim a deduction. Now, what is new this year, and because of COVID, it's called the other employment expenses, for people working at home because of COVID. Okay, to be eligible for this particular deduction, you have had to have worked from home at least 50% of your time and for at least 4 consecutive weeks. Now, there are 2 ways you can calculate the benefit. There is what's called the temporary flat rate, which is basically $2 a day to a maximum of 200 days for 200 days. So the maximum deduction is $400 that you can get. And that is very simple. When you put it in the calculation, just say, okay, from what date did you have to work from home because of COVID? And as long as you have your 50% of the time and 4 consecutive weeks, you can claim that $400, no questions asked, very simple to do. Okay. There's also another method called the detailed method. Okay. This is a little bit different. It's more for most people. If you rent an apartment, if you live in your home, sorry, as opposed to renting an apartment, in all likelihood, it's more beneficial to you get back more by claiming the temporary flat rate. Okay, with the detailed one, it may be more beneficial if you are living in an apartment and you're paying rent. I'll tell you how it's calculated. So what you have to claim this under the detailed method, you have to get what's called a T2200S, which is a declaration of conditions employment for working at home due to COVID from your employer. If you don't get that from your employer, you're going to have no choice but to claim the temporary flat rate method. Now, under the detailed method, how you calculate it is eligible expenses include your rent, your utilities, which is electricity, water, and heat. If you live in a condo, the utility portion of your condo fees, any maintenance for minor repairs, cleaning supplies, light bulbs, paint, etc. Your home internet access fees, office supplies, employment use of basic cell phone service plan, or also any long distance related to your employment. How this is basically calculated is that I'll give you a very simplistic example of how this is calculated. You will add up all your expenses and say, for example, you add up all your expenses and you come to your total, say maybe $2,000 for the year. Okay. Now, if I am using, say, a room in my house, you may look at square footage in relation to the whole of your house. So if my room in my house is 1,000 square feet and the room that I'm in is 100 square feet, that's like a tenth of a tenth of my house that I'm using solely, say, for example, for where I'm working from as my work location. Maybe I have an office in my house, then a tenth of what I pay of those expenses that we just talked about, the rent, the utilities, I will be able to claim that. Okay, but I'm going to need to keep my records as proof that these are what I have paid in case it's ever reviewed. Okay, so it can be done. It's a little bit more work, but you can't claim it if you don't get that T2200S from your employer, which some employers will give you. I know my employer did not give me that particular form, so I went with the temporary flat rate method. Another deduction that you could get is moving expenses. So if you're a student, or if you're not a student, but you moved to go to a job, to begin working at a job, and you have moved at least 40 kilometers closer, either to your educational institution or to your job, you may be able to claim moving expenses. Now, if you are a student and you've moved closer to university, if you get any scholarships or fellowships or bursaries or prizes or research grants, you can offset your moving expenses against those expenses. Okay. But just because if you're just moving to go to university and you don't have that income, you're not moving to a job, those moving expenses would not be deductible. If you moved, again, to relocated for both attended educational institution full-time as well as to be employed, you'll be able to deduct your those moving expenses from your income, not only from your awards and your prizes and your grants, but also from the employment income that you're going to be getting at that location. Okay, so you have your total income, which is everything that you earned or all the money that you made. You deduct your RRSP contributions, any annual union dues, your moving expenses, your childcare expenses, your other employment expenses, or any of the other deductions that I've mentioned previously that may apply to you, and you get what's called your net income. Okay, most people, their net income, their taxable income will be their net income. Okay. What may reduce your net income is if you have a capital gains deduction. For example, if you sold your primary residence, you may be able to get a capital gain deduction. Or if you have any losses, capital losses for prior years, you may be able to get a deduction. But for most normal people, regular people that may just have T4 income, most of your net income will be equal to your taxable income. So then, how are taxes calculated? Canada has what's called a graduated taxation system. Okay, and the lowest tax rate is from 15% to 33%. So if you, and then based on your income, obviously that's how it'll determine how much taxes you have to pay. So if say for example, I made $100,000 a year, okay, my first $48,000 will be taxed at 15%. Between $48,000 and $95,000, it will be taxed at 20.5%. And between $97,000, and because I'm in there, and to the 100,000, that would be taxed at the next tax rate, which is 26%. So under 48,000, it's 15%. Between 48,000 and 97,000, tax rate goes up to 20.5. Gradually to the highest tax rate is 33%. So if you make more than any money that you make over $214,000 will be taxed at 33%. Ontario, and that's for federal, only federal. I'm assuming most of us are here from Ontario. Their tax rate goes from 5.05% to 13.6%. So based on the taxable income that you have, you'll determine it based on the tax rates that I've mentioned, and you come up with the tax payable. But you're allowed to take, what you're also allowed deductions from your tax based on that calculation called non-refundable tax credits. Now, federal non-refundable tax credits reduce your tax up to the amount owing. So what they're called non-refundable is that you can't reduce your income below zero using these particular tax credits. Okay, so they're not going to put you in a refundable position. They'll just reduce your income down to zero at the most. So let me go over a couple of what are some of the more popular federal tax credits. There's a basic personal amount. And if your income is $150,000 or less, this amount is $13,229. And it reduces, if your income is more than $150,000, it gradually gets reduced and until $214,000, which it will be reduced to $12,298. So that's your basic, everybody gets that, okay? If you're older, born in 1955 or earlier, you may be able to get an age amount. If you report any kind of employment income, you can get $1,245 or your total employment income, whichever is less. So if you make more than $1,200 in a year, you'll be able to get that $1,245 as a non-refundable tax credit. Any CPP, Canadian Pension Plan contributions that come off of your salary, this is where you factor them in getting a non-refundable tax credit, or any insurance premiums that you pay that come out of your paycheck. This is where you're going to get it. This new digital news subscription expenses, which is there's a maximum of $500. This is where you'll get a non-refundable tax credit for that. If you have medical expenses, potentially you can get this non-refundable tax credit, but it has to be over, I think it's 3% of your income. Any medical expenses over that, you'll be able to get a non-refundable tax credit for that. If you have any dependent children that are born after 2000 or later, you can get a credit for that. If you have interest that you paid on a student loan, you can get that as well. Now, if you are in a position where you don't need it to reduce your income, you can put off claiming that. You don't have to necessarily claim it right away. You can claim it in a year. You can carry forward that interest and claim it in a year where you may want to use it to reduce your income. For tuition, tuition, education, and textbooks amounts, this is where you can get a credit. You no longer have the education and textbooks amount, but if you had some from previous years that you've carried forward, you can get a credit on those. Your tuition, to claim this credit, again, as I mentioned earlier, you're going to need your T2202. If you are enrolled in a Canadian institution, if you're outside of Canada, it may be a TL11A, but you're going to need that for claiming it. One thing as well, if you can't use all of the tuition credit, you can also transfer that credit to a family member, your spouse, your parents, your common law partner, your grandparents. You can transfer up to a maximum of $500 or $5,000, which would help reduce their taxes. And you can also carry forward any unused for yourself, but only you will be able to use it when you carry forward. And then also another deduction when I talked about briefly earlier are donations. For any donations that you make, you can get a part. This all goes into the calculation of your non-refundable tax credits. And basically, it's about 15% that you get for your first $200 that you donate in a year, and anything after that, you will get 29%. Okay, and so you add all these different refundable, the things you can claim a refundable tax credit on, and then you come up with an amount, and that amount is normally multiplied by 15%. So if everything you pay, you get the calculation is about 15%, and you can use that to reduce your federal tax to come up with what's called your net tax payable. Provincial and territorial tax, pretty much it's the same kind of rules as just as I told you how we calculated the tax. The only difference is that the rates or the percentages may change. So Ontario also has non-refundable tax credits that will be used to reduce your tax that you have to pay if you're in Ontario. And the brackets may be a bit different how they allocate the gradual tax that gets how you calculate your income, but it's all basically the same. So you add the net tax that you owe, for net federal tax that you owe, your provincial tax, and you come up with a total tax, and that's how much money you have to pay. Of course, with our employment income, we know that our employers have deducted taxes on our paychecks every time we get it. So we reduce based on what we calculate we owe for our federal and our provincial, we reduce it by the tax that was already remitted on our behalf by our employers, and you're either in a refundable position or you're in a payable position. Hopefully, many of us are in a refundable position as opposed to having to pay. You know, as I said, as an employee, there are very few deductions that we can really get. You know, you can get for donations. Donations is what a lot of people use as a deduction. RSP contributions are what people do. But other than that, there's really not that many deductions that we can get. You know, a little tip I would tell you is if you find yourself constantly being in a payable position at the end of the year, you know, you can go to your employer and you can say, you know, can you please take out of each paycheck, can you take out a little bit more taxes? And they'll do that. They always, whenever you start a job, they give you a form, and you know that you put in, okay, you know, they want, if you have dependents or whatever, or you know, whatever your personal is, only your basic amount that's going to be deducted. You tell them, you fill out a form, and that's what they use to calculate your taxes. But you can, there's always a spot that says, you know, do you want additional taxes taken off? So, you know, it may be a bit easier or a easier pill to swallow if it's a little bit less during the year than coming to the end of the year and you find yourself having to pay back a lot of money. Now, once you file your return, and then the CRA will determine if you're entitled to any credits. Okay, so if you're entitled to, based on what you file and the amounts in your tax return, they will automatically determine if you are entitled to the GST, HST credit, or if you're entitled to Ontario has what's called, if you pay rent or property taxes for your principal residence, or you lived in a student residence, you may also be able to get what's called part of the Ontario Trillium credit. So they'll use the information that you file as well to determine your Canada Child Benefit, right? So it's always in your interest to file, because your records are up to date, and you may be getting back credits that that you wouldn't get if you didn't file.
Sorry.
So let's talk about. Hello.
Sorry, Astrid. There's a question on the chat room, whereby does it matter if the employment is full-time or part-time for claiming move-in expenses?
Normally, it doesn't matter if it's full-time or part-time. What is important is that you're moving for a job and you're moving 40 kilometers closer. So that's what's important. And if it's only part-time, you can only claim up to the amount that you're making at that location. And if you don't claim it in this year, you can carry forward your moving expenses.
Thank you, Astrid.
You're welcome. Okay, so let's talk about doing your return online, because I hope I have put some fire up under you now that you want to do your return online. So when you're doing your return online, again, as I said, make sure you have a certified software that you will be doing, and one that's easy for you to use. You know, very simple. You enter your, normally they have an interview section. You'll enter any identification information about yourself, your name, your address, your social insurance number, your marital status. They'll ask you questions about your sources of income. And if you select like employment income, you'll see that the T4 option will come in and it'll tell you what boxes on your T4, you know, to put where. So it's very simple. As long as you can read, I strongly believe as long as you can read, you can fill in a tax return. Okay. So then you'll enter any of the other information that they ask for from your any of your information slips. If you have investment income, again, in your interview, you'll select investment income. And you just enter all that information in there, and then the software will calculate your total income, your deductions, any credit that you're eligible for. If there are any issues, there'll be an error message, and it'll tell you what it is, and it'll advise you, okay, you have an error in this area, and then you can go and you can correct that. Once you've corrected that, you can calculate your refund or your balance owing. You can print and view your finished tax return, and then you can file your tax return online. This year, when I was filing my tax return online, when you're filing online now, there is a spot remember, every year you file, you get a notice of assessment. And on your notice of assessment from last year that you would have received in your 2019, on the first page, and it would be very, very small, there would be a series of numbers and letters. So if you have that particular code, I know the software that I used asked me for that particular code. You could still file it without that particular code, but it wanted that particular code to be put in so that if you ever had to call CRA to discuss my 2020 return, if that code was there, I could use the information that in my filed return for when they're trying to verify who I am and talking to the CRA. I could use my current return that I filed. So it's normally letters and numbers. I didn't even notice it when I got my my reassessment from last year. I'm on my account, so I went on my account. I pulled up my reassessment from last year, and sure enough, it actually had it on the electronic one, and it was a lot easier to see on the electronic one than it was to see on the actual paper copy. Okay. So what information should I include? If you file your online return, there's really nothing to include because it's all electronic, okay? And you just send off your return online. But you have to keep all your receipts and the related documents because Canada Revenue Agency may contact you if they want to see. They may say, okay, well, for your medical expenses, I noticed you've claimed medical expenses. Can you please send in documents to support your medical expenses? So you may, if you have a My Account, you can upload those documents through My Account and it can go quickly, or you can do the snail mail by putting it in the envelope and sending it off. Both ways are easily acceptable. But if you do it online, you don't have to send, everything goes to the CRA, you don't have to send anything. If you're doing a paper return, however, you have to include one copy of all your T4 slips and all the schedules that you use to prepare, like the schedules calculating your taxes, or if, for example, you're claiming tuition, you may have what's called Schedule 11 with your tuition fees. So everything has to go, unless it specifically says, keep this for your records. and you don't have to include it, you have to include everything in there. So it's a lot more cumbersome. And again, you should always keep that documentation. So what I'm going to do now, I'm going to just show you a quick video of filing online. Okay, so let me go here, share screen.
It's a quiet Saturday morning in February at Mike's house. The kids are playing outside, the kettle's on, and like millions of Canadians, Mike is getting ready to do his taxes. Mike goes to the Get Ready page on the Canada.ca website and follows the steps outlined in the Doing Your Taxes section. Mike knows that being prepared will make filing his return easier. To begin, he gets all the information he needs in front of him, such as T4 slips, receipts, and has his social insurance number and a cup of tea. Mike prefers to do his taxes online because it's fast, easy, and secure. Mike is already signed up for the CRA's My Account service, so he can do his taxes online and use the Autofill My Return service to automatically fill in parts of his tax return. Mike clicks Find Certified Tax Software on the Get Ready page and selects a free software. After Mike follows the Autofill My Return instructions, parts of his return are automatically filled in with tax information for the year, such as information from T4 slips. This makes Mike's job much easier. No more typing in everything by hand. He also checks the Get Ready page to see what benefits, credits, and tax deductions he might be eligible for. Mike can claim medical expenses, moving expenses, childcare expenses, and more to reduce the amount of tax he has to pay. When all of Mike's information is entered, he checks it over to be sure it's correct. The software then calculates Mike's taxes and tells him if he owes money or gets a refund. To finish, Mike sends his return electronically to the CRA and receives a confirmation number, which he keeps for his records. Mike can receive his notice of assessment electronically by signing up for online mail. Mike can also use the Express NOA service so he can view his notice of assessment right after his return has been received and processed by the CRA. Now, Mike does not have to wait. And because Mike uses direct deposit, he should expect his refund in his bank account in as little as 8 business days. Plus, since Mike has sent the CRA his tax return, he will continue getting his benefit payments without any delays or interruptions. Mike still has time to go play outside with his kids because filing his taxes online was fast, easy, and secure. Visit canada.ca/taxes-get-ready to find out more about how to do your income tax and benefit return online. A message from the Canada Revenue Agency.
As we see, very easy to file our taxes online. Not too complicated at all. I'm coming up to my last couple of slides. So after you file your tax return, a little while after you file your tax return, you will get a notice of reassessment. And if it may be as you filed, or they may, can everybody see me? Can everyone hear me? Using slideshow, okay, yeah. So after you file, you'll get a notice of reassessment, and it will either be as filed, or if, for example, maybe you forgot a T5 slip, which is an investment slip, and it's in the CRA's records, that your return may be adjusted, and that will be reflected on your notice of reassessment. Okay, so you either get reassessed as filed, or changes may be made to your reassessment. Again, we talked about if you're not happy with that, you can file a notice of objection, what we talked about last time in the first session. If you are getting a refund, that's great. Direct deposit is always the fastest way and most convenient way to get your refund. If you are owing, we know we want to make it a payment as soon as possible or before the deadline so that we don't incur any interest charges. If, for example, you have you realize after you file it, as I mentioned earlier, that there's an adjustment, wait until you get assessed. And then after you get assessed, you can file what's called a T1 adjustment form. You can do it online. It's really, really very simple. I had to do it this year because I had forgotten something came in after I filed. Very, very simple to do. You can upload all your documents right away. If you have my account. If you don't have my account, not a problem. You can download that form, the T1 adjustment form from the CRA website. You can do the fillable PDF. So you can put in all your information, you can print it out, sign it, and then you can send it off to the CRA, to your tax center, and it can be processed. So how long should you keep your records? You should keep your records for 6 years, because the CRA may ask you to provide supporting documentation other than official receipts. So you may need bank statements, cancel checks, as a proof of any deductions or any credits that you claim. You should keep a copy of your return, your related notice of assessment, any notices of reassessment if your initial assessment gets changed. And it's important to keep these documents because a lot of the times, like your notice of reassessment that you get, it will show you, it will tell you what your contribution to your RRSP for the following year will be. So always good to keep these documents. And that is it for my presentation. So what did we learn today? What did we do? A quick recap. We talked about how to complete the return. We talked about how the taxes are calculated, the different methods of filing your tax return. And as again, I can't stress it, very, very, very important to be organized. Taxes are not complicated, but it's important that you know, once you know the basics and you organize your tax receipts, it's a lot simpler. And it's one of those things, the more you do it, the more comfortable you will become and the easier it will become. So I really want to thank you for your time. Does anybody have any questions? Yes, Saha. Saja? Oh, sorry, I can't hear you. Sorry. I can't hear you, Saja, sorry.
Saja, are you on mute?
Can you hear me now?
Yes, I can.
Okay. Thank you for the session. I just had a question because I missed something that you said about the new COVID other expenses working from home. You said, yes, you said one is better if you're renting and one is better if you're not, but I missed which is which, the flat rate versus the.
So, if you're renting, if the benefit will be better for you with the it may be better, not necessarily always, but it may be better with the more detailed, because you can include your rent in your calculation.
Okay.
Right?
Okay.
So, but you remember, so it has to be so. And if you're renting, maybe you have one room, you have maybe a 3-room apartment, or and you may have one of the bedrooms, which may be a quarter of your apartment, just using for, you have an office. So you may have a larger percentage of the whole apartment as a whole. So it will be a higher percentage you'll be able to deduct. But if you are if you are at home and you have you're in your own home, you can't deduct your mortgage or anything like that, and so it'll basically just be like your utilities and minor stuff. So the flat rate will be more beneficial.
Okay, thank you.
You're welcome. Any other questions? Well, thank you so much for your time.
Sorry, one more question. I think Roselawn has has a question. She lives in the Gatineau region. So she lives in Ontario but works in Quebec. Are the taxes that they take from your paycheck for Quebec given back to you?
For that particular one, it is taken, yes, it will be. But I've seen it online when I've done it, because you're gonna have, because of there's a difference because of where you live and where you work. So it will balance out in the end, right? But when for Quebec, the taxes are higher. So you may have more coming off your paycheck up front, but you will get it back when you file your return.
One more question.
So you will get it back.
We wanted to know, where could we find community volunteer tax clinics?
You can go on to the Canada Revenue Agency website, and they will have a list of, you'll be able to contact them through there. Oh, the marginal tax, okay. The marginal tax rate is, okay. The marginal tax rate, Canada, it's, as I said, it's a gradual, you're very welcome, Winsome. Thanks for coming. The marginal tax rate is on a federal, it's on all returns. It's a graduated tax system, okay? So as I said, it begins at 15% and then it goes up 20.5, 26. So as your income goes up, the first portion of your income up to 48% will be taxed at 15%. Between, as I said, between 48 and 97%, it will be taxed at the next rate, which is 20.5. So as you go up, the more you make, the more you have to pay. And the maximum rate is 33%. So the lowest rate is 15, the highest rate is 33% for the federal portion. And then for the Ontario, if you're in Ontario, it is 5.05% to 13%. So as the marginal works is, as the more you make, the more you have to pay. But it's not, you don't have to pay, like if I made say $100,000, it's not going to be taxed at that 26%, the whole 100,000. No, it's based on, it'll be like, say if I apportioned it between the various groupings, and it will be taxed at that incremental level. You're welcome.
Thank you, Astrid.
Very welcome. Thank you.
If anyone else has any other questions, please, you can put it in the chat just before we end it. And also, we posted the feedback form. We would really appreciate it if you could take a couple of seconds, probably max 30 seconds to fill it out, just to help us form other events in the future. I can repost it, just in case it got lost in the chat.
Sorry. Before you go, I just want to let you know that in April, we will be doing a repeat of the budgeting session. If you missed that one, in May we will be doing a session on insurance. Very, very important. We'll be doing that session in May, and then over the summer we will be having sessions in June, July, and August. We're going to have some really good sessions. One of them will be called The Psychology of Savings. I did that course a couple weeks ago, and it blew me away. And I would really, a lot of us have that problem. How do we save? We have problems saving, but this is a really good course, a really good presentation that we will we'll have a special presenter coming in for that. So please join us then. We'll also be doing one, it's kind of like a finance 101, but it will be one that will complement the budgeting courses. So those will be coming in. We got, as I said, really exciting courses coming up. So please join us for those. And if there's anything that you want to see that you want us to offer as far as, when it comes to financial matters, please let us know, and we can maybe tailor something to suit your particular need, because we really want you to be well informed, and we want to meet what you want. We want to meet your needs, because that's important, So please let us know if there's any session that you would want us to cover. So thanks again, everyone, for your time.